Hi, I'm Pattu from freefincal. The Sensex closed above 50,000 on the 3rd of February. Let's take a look at its 42-year journey and learn what we can with respect to risk and reward. So the BSE provides closing price excluding dividends from the 3rd of April 1979, and on that date the Sensex was 124.15. I guess it was set to 100 as on 1st April 1979. Actual trading started only in the mid of the 80s, in middle of 80s, 1985, 86, I think. So the data from 1979 to the mid 80s is projected and is not true. And the dividends will typically be about 1.5% to 2% extra. Sometimes during recessional periods it will be about 1% or so. We had already talked about Sensex charts using log scales, etc., several times, and just a few weeks ago I had talked about how over the last 41 years, if you take the 16% return, half of that 16% return came from just 3 good years. And we had also talked about the Sensex staircase. We'll have a look at the staircase again. This is the Sensex staircase that I keep talking about. This is the Sensex in log scale. The best way to plot it is to use the log 10. So you can do it in Excel. Excel has got an automated log option, but if you use that, you won't get this kind of nice graduations. It's better for you to use log 10, calculate the value of log 10 and plot that, and that's how the Sensex would look like. The advantage of using the log is that it pulls out all these details from the past, and you can actually compare rises and falls properly. For example, if I take any up movement over this 2.5 to 3, that would be the same as this up movement from 3 to 3.5, or a down movement, and so on. So I can actually compare in 0.5 graduations here, bull runs and bear runs comparatively. So compared to, you can find this fall, it can be directly compared with this fall and the corona fall, and so on. The red line is of course just a schematic. It shows the bull runs and the range bound movements, or when the market was underwater, that is, it hit an all-time high and it was below that, and it took time, and the time it took for recovery, and so on. And you can see here the staircase is pretty steep here, and since then it has been relatively shallow. This has been more shallower than that, less this is even more shallower than that, and so on and so on and so on. And that's the reason why this daily fluctuations, up and down fluctuations, they have become less and less violent over time. What is known as volatility bunching. That is, volatility bunching means that if there is such a large up movement, then there will be a large down movement, or if there is a large down movement, it will be followed by a large up movement. Small up movements will be followed by small down movements, and vice versa. That's called volatility bunching. It bunches together. High volatility and low volatility bunch together, and you can see how these the violent oscillations also lead to huge upticks or downticks, and that has kind of become a lot more sedate over time. And this is the cumulative standard deviation from the inception of the Sensex. That is, what I do is I calculate the daily returns from April 3rd, 1979, and I keep calculating the standard deviation based on daily returns. With each passing day, I keep increasing the standard deviation range, and you can see how the stock market has been highly volatile up to the Harshad Mehta scandal times, early 90s, and since then it's kind of been going down generally. If you look at the similar graph for the S&P 500, you can see, you can get data from 1900. Even the total returns data is available. You can see how the depressions in the 1930s, 1929 to 39, that resulted in a huge increase in volatility. And since that great depression decade of the 1930s, the market volatility has been gradually falling down. compared to this increase in volatility, the dot-com crisis, the 2008 crisis, the corona crisis, they're basically nowhere to be seen, and that's how small they are, relatively speaking. Whereas if you were to plot the 10-year rolling standard deviation, that is, you take the 10-year standard deviation based on daily returns and you roll over that window, you get something amazing. Except for the period of that Great Depression, during that the decade of that Great Depression, everywhere else the stock market volatility has been pretty much range bound and pretty much constant. Whether you are investing for a decade in the 1950s, 60s, 70s, 80s, the amount of volatility has been more or less the same, and that's extraordinary. But that we don't have that kind of data, that long data for the Indian markets. The best that we can do is use 5-year volatility, and even that 5-year volatility you can see for the Harshad during the in the build up to the Harshad Mehta scam, it increased, crashed. Then during in the build up to the 2001 dot-com crisis, it built up again, crashed. Then the 2008 build up again, crashed, and then it kept falling down a bit. And then this is the actual corona crisis. And relative to that, relative to these peaks, this is actually quite a fairly small peak. Now what you see here is the 5,000 milestones. So it started at 100, then it became 5,000, 10,000, 15,000, 20,000, and so on and so on and so on, and then it fell down a few 5,000 points and so on. And these are the corresponding absolute gains for every 5,000 milestone. And this is the detailed table of when those milestones occurred. So from April 79, where it was just 100, it took 20 years for the Sensex to reach 5,000, and then it took only the next 5,000 occurred in 6 years, the next 5,000 occurred in just 1.5 years, the next 5,000 occurred in 0.47 years, and so on and so on and so on. It took, you can see you have all kind of graduations here, readings here, but what you notice is the 5,000s that you've been seeing in 2020, you saw 30,000, you saw 25,000, 30,000, 35,000, 40,000, 45,000, 50,000. All those occurred last year since the crash. And all of them have been occurring within the space of weeks, if not months. But that's not a reflection of the India growth story and so on. Some people talk about India growth story. They keep saying all sort of things. They say first 20 years, it took 20 years for Sensex to gain 5,000 points, and the next 20 years it gained 45,000 points, and blah blah blah. But all that is not really true, because for the first 5,000, it's a very big mountain. All the other milestones of 5,000s are much smaller milestones, because the baseline is higher. It is becoming 20, 25,000, 40,000 and so on. So the increase of 5,000 is actually the absolute gain associated with that increase is significantly smaller. And you can see here, so the first 5,000 is 98% gain, 50%, 33%, 25%, 19, 17, 14, 12, 11, 10. So it keeps falling down. So basically this 5,000 point increase is not a very big deal. So tomorrow Sensex will be 55,000. It means nothing. It doesn't mean you have got returns, right? I mean, yeah, you can see from the table here, there are very poor returns here for those 5,000 increases. They have 1%, 7% and so on. So this Sensex value doesn't mean anything much. Don't go by that. They will plot all sort of pictures saying oil crisis occurred here, inflation occurred here, and so on. All those mean very little. It's very clear that the stock market volatility is gradually coming down over the years, and what this means is that again and again I keep saying the same thing: returns will keep going down in future, and that is the most important point. And the other thing is that when there is a range bound market, when that 5,000 can increase, the next 5,000 milestone can come in weeks, or it can come in months, or it can take years to come. What investors should fear is not the crash. They should fear that 5,000 taking years. If that 5,000 takes years to come, then your returns will be significantly lower. And if things crash very fast, then they will also move up very fast because of the volatility bunching. But if the market is range bound for years, then you have lost time. like all of us know, if you lost time, you lost it forever. There's no such thing as a notional time loss. So that is the reason why risk management is very important. Don't listen to all these stories about, oh, Sensex is this, Sensex is that. You have to look at the time associated with those gains and manage the risk in your portfolio. Something, some nonsense I keep saying every day. Bye bye.